In this analysis paper presentation, I will discuss two companies and use multiple valuation methods to decide if they are over or undervalued. The two companies I have chosen is Dick's Sporting Goods and Target Corporation. Here is a short summary of what I will do. I will compare them to their sector averages and determine their intrinsic value, as well as compare relative multiples to their sector values to see if they are over or undervalued. The intrinsic value is the real value of a stock, and it can be a good indicator of whether you should buy or sell. I will first discuss Dick's Sporting Goods, value it, and then repeat the process with Target. Here is a brief history of Dick's Sporting Goods. Dick's Sporting Goods was founded in 1948 by Richard Dick Stack. He was 18 at the time and was a worker at a bait and tackle shop when his boss asked him to make a suggestion for some products that they could buy for the shop. He did, but then was promptly rebuffed by his manager saying that he didn't know what he was doing. So he went to his grandmother, talked to her about it, and she gave him $300 to start his own business. It was first a bait and tackle shop, but in 1958 it became a sports goods store known as Dick's Clothing and Sporting Goods. In 1992, Dick's began expanding outside Binghamton and relocated to Pittsburgh. By 1996, 50 stores were in operation. It was estimated to have $10 million in sales per store. In 1999, it changed its name to Dick's Sporting Goods officially. There are more than 357 stores in 38 states as of 2008, but Dick's is now the largest sporting goods store or retail store of approximately 850 stores as of 2020. So on this slide, I have documented Dick's Sporting Goods statistics for the year 2023 to the left in the chart, and then to the right, I explained the equations for how to find each of these, or at least a summary of each of these terms that I'm about to mention. I have found the earnings per share, the revenue, the book value, the enterprise value, the EBITDA, and the growth for the next 5 years. So the earnings per share, or EPS, is found by dividing the profit by the outstanding shares. And I found that it is 10.78. The revenue is $12 billion. The book value is $2.2 billion. Enterprise value is $14 billion. And the EBITDA is $1.8 billion. Now, the enterprise value is the market cap plus the total debt minus the cash or the cash equivalents, which can be found in your income statement. For the EBITDA is found it's before interest, taxes, depreciation, and amortization, and is a measure of a company's profitability of the operating business only. And I put the growth for the next 5 years to give you a better understanding of the projected wealth of Dick's Sporting Goods. On this slide, I have compared Dick's Sporting Goods to the average in its sector, which is the specialty retailer sector. I have decided to use many relative multiples to give a good estimate of if it's over or undervalued. As you'll see, I've done the trailing, actual, and forward PEs and found that on average Dick's Sporting Goods has a lower PE than its industry. The only positive relative multiple comparison was the PEG ratio, which I found was 2.24 compared to 1.95, especially the retailer section. So usually PEG, the higher you get above 1, the more overvalued it is, but when you compare it to the sector, the 1.95 would say be the average, and this 2.24 shows that it could be overvalued. But if you were to look at the other relative multiple comparisons, you'll find that Dick's Sporting Goods is undervalued when compared to its sector by quite a bit. In fact, the PB, the price to booking, is even nearly half of the specialty retailer section. And Dick's is projected to get even lower due to its growth in the next 5 years compared to its specialty retailer section. So its growth is slower. I've also compared it to its EV over EBITDA, which is the enterprise value over EBITDA, and found that Dick's Sporting Goods is 7.69 to specialty retailers 8.4. For this presentation, I did two valuation models, the discount cash flow model seen here and the dividend discount model. There was a problem with the dividend discount model for both of my companies because of something I will discuss later on. So I wasn't able to use it to get an accurate result for my intrinsic value. But the discount cash flow model worked very well and gave me some data that really aligned with what my relative multiples were saying. So first of all, the average growth over these past 10 years is 72%. Now, a lot of that is from years 21 and 22, but the next few years are projected to have higher free cash flow. So 72% is a good way to estimate what what the increase will be. I've also used perpetual growth of 2.5%, which is the growth of the U.S. It's the average U.S. growth of the economy. And I used the discount rate, or WACC, of 11%, which I had found for Dick's Sporting Goods. Now, over here, I did these multiplications to find that the intrinsic value for the discount cash flow model for Dick's Sporting Goods is $148.96, but the current price is $140, which leads me to believe that Dick's Sporting Goods is undervalued. So to summarize, the intrinsic value of Dick's Sporting Goods is $148.96, while its price is at $140.91, which leads me to believe that it is undervalued, since it is 6% higher than actual price. Now, the low PE indicates it may be undervalued as well, which correlates with my intrinsic value. The price to book ratio and price to sales was also less than the sector average, and the EV over EBITDA of 7.69 compared to a sector average of 8.4 also indicates it might be undervalued. So overall, I believe that it is a good investment to make, and its price is definitely lower than it should be. Now I will discuss the second company in this presentation, Target. It was founded in 1902 by George D. Dayton, originally called Dayton Dry Goods Company. It opened its first Target store in 1967, and Dayton Hutton Corporation was renamed to Target in 2000. It offers a wide range of products, shoes, different types of apparel, and home appliances. There's more than 368,000 employees, and it's considered one of the top 2,000 largest public companies in the world. As I did for Dick's Sporting Goods, I made a chart with Target statistics. This is the EPS, revenue, book value, enterprise value, EBITDA, and growth for the next 5 years of Target. And to the right, you'll see an explanation of what these are and how to find them. Target's EPS, or earnings per share, is 5.98. Its revenue is $109 billion. Book value is $11 billion. Enterprise value is $88.7 billion. Its EBITDA is $6.59 billion. And its growth for the next 5 years is a negative 7.51%, which is worrying. Here are the 8 relative multiple comparisons for Target. I compared it to the general retailer sector, which is what it's part of. The trailing actual and forward PE for this sector is lower than Target's by a large margin. Its book to value is higher than general retailer, and the growth is for Target is much lower than general retailer. In fact, it's a negative, which means that it's declining. And its EV over EBITDA I found was 13.5 to general retailers 11.9, which means it is overvalued. Many of these relative multiples point to an overvalued company. Here is the discount cash flow model for Target. I averaged up the growth of the free cash flow from the past 10 years and found that the average growth rate for Target was 33%. I used for the perpetual growth of 2.5, which is the average growth of the economy each year, and the WACC of 9.5, which is what it's averaged to be. Here, using these, I found that the intrinsic value for Target is $110.26, but its current price is $152.53, which means that it is greatly overvalued compared to its real value. So to summarize, the intrinsic value of Target was $110.26, while its price as of today is $152.53, which means that it is greatly overvalued compared to what it's actually worth. In fact, it is 28% lower than its actual price as of today. The high PE indicates it may be overvalued as well, and the price to book ratio is more than the sector average. The EV EBITDA is 13.5 compared to its sector average of 11.9, which also indicates that it might be overvalued. So I'm going to conclude that Target is very overvalued, and you can use short selling or put options to profit from this. Now I will discuss the problem of the dividend discount model. The problem is if the company's dividend growth rate exceeds the expected return rate, you cannot calculate a value because you get a negative denominator in the formula. And for example, both the Target and DICK'S had a higher dividend growth rate than its WACC. As you'll see here, I average up the growth rates to find that there's a 27% growth rate for DICK'S Sporting Goods, while its WACC was only at 11%. If you were to calculate this out, you would find the intrinsic value is negative $31.11, which isn't possible for a currency. So in the current price, 149, which would have said that the difference is 580.94%. And that's not possible. You're not able to calculate this because the growth rate is higher than the WACC. I did a similar model with Target. I tried a different approach to see if I get different results for both of them, and this one is more clear to show the problem. I averaged up the yearly growth using a trailing 12-month dividend and found that the average growth was 11%, but the WACC is 9.5%. I've tried it with different years to see if I can get it below, but it only grows past the 11th year. And so since the numerator, or DO times 1 plus G, is 4.8, and the denominator is negative 1.7%, or R minus G, it is not possible to use this function. In conclusion, I believe that DICK'S Sporting Goods is undervalued, while Target is greatly overvalued. And I believe that each one can give an investor a chance to make a lot of money if used correctly. Thank you, and have a good day. In conclusion, using the relative models and valuation models, I conclude that Dick's Sporting Goods is undervalued and Target is overvalued. These valuation models have greatly helped me come to this conclusion since they really correlate with each other. Thank you and have a good day.